Today, we recommend a sell for Houlihan Lokey, an investment bank from LA, at a target price of 83. In our view, the market is assuming a never-ending favorable M&A environment, but we don't believe trees grow to the sky.
Houlihan Lokey is a strategically well-positioned company with a healthy balance sheet that has delivered exceptional shareholder returns by growing revenues, expanding margins, and growing EPS at a 28% compounded annual rate. Houlihan's results have been catapulted by its strong corporate finance segment that specializes in M&A and is complemented by its countercyclical financial restructuring business. The business is a leader within the middle market investment banking industry and dominate in the US. The recent acquisition of GCA highlights the company's efforts to expand its geographical reach into the Asian and European markets. These new regions could create new growth runways, but acquisition integration is not without significant risks.
We recognize Houlihan is an exceptional company. Houlihan has delivered a 5-year average return on invested capital of 18%. We believe it has established competitive advantages with its talent and expertise, which has made it a proven go-to partner in the space. This advantage appears sustainable because of its above-average compensation packages and culture, which attracts leading talent.
Despite Houlihan's many positive attributes, the share price ignores substantial risks that we have identified. A stock that assumes unlimited growth, like a tree growing to the sky, is quite risky if that growth doesn't materialize. The business environment Houlihan faces in the next several years will almost certainly be more challenging than the next decade. The Fed has maintained a highly accommodative monetary policy since the financial crisis in 2008, which has created an extremely unfavorable environment for M&A and advisory activity. We observe drivers of corporate finance such as record amounts of dry powder in private equity, low investor uncertainty, and high CEO confidence accelerate M&A activity and lead to soaring company valuations in 2021. As we have seen year to date, the Fed's need to curtail inflation is reversing many of the favorable trends recently enjoyed. The Fed and central banks around the world are becoming more hawkish as inflation numbers run at historical highs. In addition, recent geopolitical events have weighed on investor confidence and lowered valuations, likely slowing M&A activity, creating a more challenging raising capital environment, and tapping the brakes on exit markets. Another headwind is the FTC and DOJ adopting a stricter approach to antitrust laws, which will likely slow US M&A further. The market continues to assume Houlihan's past growth trends continue, but we envision turbulence ahead. We ran 3 scenarios: a slowdown, a recession, and the status quo to gauge the risk-reward profile of the shares. In the slowdown scenario, we expect that the market will experience a contraction within our investment timeline. We support this conclusion by analyzing past business cycles and determine the probability of this cycle lasting 5 more years, 17 in total, as low. We also observe detrimental historical market reactions to an increasingly hawkish Fed, similar to what has been experienced so far in 2022. In the recession scenario, we expect the Fed to slow the economy at a minimum and at a worst cause a recession if corrective monetary policies play out to be too aggressive. In the status quo scenario, we predict that the factors that contributed to the strong performance in 2021 will continue to drive market activity for the next 5 years, and we assume that the Fed's actions to combat inflation pressures will not significantly disrupt markets.
Through our scenario analysis, we believe an investment in Houlihan offers a weak risk and reward profile for investors. We value Houlihan based on our DCF model and validate our price target with a residual income and relative valuation model. In our most likely scenario, we expect a slowdown in the economy will cause a deceleration in revenue growth alongside operating margin contraction due to fixed cost deleveraging, rising travel and entertainment expenses, and temporary GCA margin dilution. In our discounted cash flow model, where we have key inputs, such as a weighted average cost of capital of 9.5% and a terminal growth rate of 2.5%, we value the company at $83, representing 16% downside. Our residual operating income and relative valuation model both validate our price target. In our recession scenario, we look at Houlihan's competitors' performance during the 2008 and 2009 recession while factoring in Houlihan's financial restructuring exposure. In this scenario, we project revenues declining more than 20% and operating margins contracting to 11% before rebounding. Our DCF model shows Houlihan is overvalued by 38%, and our residual income and relative valuation models show nearly identical downside risk. In our status quo scenario, where we expect Houlihan to achieve double-digit revenue growth rates and record margin expansion, the company's shares offer 31% upside. However, we view this as the least likely scenario, as there are significant risks to arrive at this valuation, such as an accommodative Fed, continued expansion of the economic cycle, record scale benefits, and material GCA acquisition synergies. With a deteriorating macro environment and Houlihan trading at a significant valuation premium to peers, we believe there is little downside protection for investors. The Fed's past highly accommodative stance has brewed the perfect environment for Houlihan, leading to record revenue growth rates and significant margin expansion. With our expectations of an unfavorable macro environment, we see downside to earnings in our two most likely scenarios. More challenging market conditions suggest sector-wide earnings disappointments are likely and puts Houlihan's premium PE multiple especially at risk. Houlihan trades at a 47% valuation premium to peers, yet it has diluted its countercyclical financial restructuring revenues by acquiring GCA. As T&E expenses normalize and the Fed implements tighter monetary policies, Houlihan's ability to continue expanding its earnings will prove difficult, and its rich valuation multiples will inevitably compress. Valuations in the industry have already begun to decline, with Evercore, Lazard, and Moelis recently experiencing significant stock price declines as investors begin discounting lower future results.
The most prominent risk to our sell recommendation is that the business cycle continues to remain strong through our investment horizon. In a friendly economic environment, Houlihan could generate double-digit revenue growth and sustain about 30% margins. While we are skeptical that the M&A cycle could last 5 more years beyond the favorable 12 we've already experienced, we cannot rule out the possibility. While there is upside to the stock price in this scenario, we view it as a very low probability for reasons previously discussed.
The second risk to our sell recommendation is Houlihan's acquisition of GCA, which enhanced its exposure to Asia and Europe, regions that offer strong growth potential. However, we believe that the market is already giving Houlihan credit for a successful acquisition, given the company's previous success achieving synergies quickly. Even if GCA adds new revenue opportunities, Houlihan's lack of international scale will make it harder to achieve pre-deal corporate margins, and considering the unprecedented size of the purchase, there is substantial integration risk that might hamper operational growth. It also appears the acquisition now looks highly dilutive at 22 times earnings, given the original assumptions made at the time of deal closing were far too optimistic.
In order to achieve higher margins similar to peers, Houlihan could trim its above-average compensation or further reduce exposure in the lower margin financial restructuring business, but doing so would create cultural risk. Reducing compensation seems like a poor short-term oriented decision, given the importance of employees to the firm's long-term success. Such action could significantly hinder future growth. Additionally, we view the countercyclical nature of the financial restructuring business favorably and believe the lower margins are a worthy trade-off. Despite Houlihan's management doing an outstanding job creating shareholder value, the company does score disappointing on ESG scores. According to Refinitiv, the company scores poorly on environmental and governance matrix, with our own independent analysis finding similar shortcomings. The biggest issue is in corporate governance due to a multi-class share structure. The company also gets lower governance grades because of its low women and minority headcount, lack of independent board member representation, and the absence of a succession plan. For other metrics, Houlihan scores above average on social and below average on environmental. To conclude, Houlihan is a well-run company that has delivered outstanding financial performance. Our sell recommendation reflects concerns that Houlihan represents a great company, but a bad stock. Investors seem to be assuming steady growth for M&A advisory work, despite obvious headwinds emerging from central bank tightening and a pullback in government fiscal stimulus. We believe the next several years are likely to be far more challenging for the industry, and Houlihan's premium valuation creates downside risk if results disappoint. Now, assuming trees grow to the sky, especially when the economic environment is rapidly changing, it makes the shares a poor risk-reward trade-off. We thank the CFA Institute for the opportunity to present our views.